It's me again. It's Mike Head from Ethical Screening, and this afternoon I'm talking to Audrey Ryan from Aegon Asset Management. If you want to introduce yourself, you don't have to tell us just how long you've been there, but I won't be able to help alluding to it. And then just a thing about what you do there and the like, and then we'll crack on.
Certainly. Good afternoon, Mike. Good afternoon, everyone. Yes, my name's Audrey Ryan. I joined the business that we have based in Edinburgh back in 1997. And prior to joining this business, I had been in the fund management industry for a couple of years, post qualification as a chartered accountant. And really, since day one, I was very interested and became involved in the co-management of our ethical equity fund, which we actually launched back in 1989. So I've been the prime fund manager on our ethical equity funds really since 1999 officially. So managed it through a variety of different economic, financial, and indeed market backdrops. Some periods have been somewhat more challenging, but it's an incredibly interesting opportunity to manage such monies. I meet very interesting clients, and of course have the opportunity to engage with lots of companies across the marketplace in a variety of different sectors. So every day is different in my working environment, but I very much love what I do, and feel it's a privilege and the opportunities I have to meet both clients and indeed companies.
The funny on that, because I looked it up earlier, because Ethical Investors, the IFA business, we started in June 89. So you launched, or Aegon, or as it was in those days,
Yes.
Scottish Equitable, that
Mm,
was launched in April 1989.
that's
So
correct.
we we're in a couple of years' time, we're going to have a 40th birthday party.
Yes, let's do that.
And
Sounds
that
good.
that will be the one, and we'll see if we can dust Lee off and bring him along and
Yeah.
say, okay, so 40 years ago, it was a different world because when that fund launched, I was still working at Friends Provident with the Stewardship Fund, and much like when you started with Scottish Equitable and now Aegon, ethical investment was about the classic sin stocks, and almost avoidance was everything.
Yeah.
And there wasn't that much, let's be fair, the things that now are so embedded, stewardship engagement, ESG, companies didn't even, if you could time travel back to then, people would think you were from Mars if you started talking about ESG and your strategies. And so much has changed, and yet still in some ways so much is the same. Are you finding that?
Yeah, I think that's a very, very fair comment. I guess in the world we're in at the moment, it is ever changing. It's a very uncertain world out there. But what we as a business continue to see is that many clients, still want to invest in a manner which very much aligns with their beliefs and or values. And clearly there are a range of funds across asset classes out there for those investors to select from. So, we have seen growth, as we all know, in certain aspects of the responsible investment forum. But ethical, whilst they may be one of the first to that marketplace, there, as far as certainly we can see, there is continued interest in investing in such vehicles. The funds themselves clearly continue to have those exclusionary based principles. So whether they be on tobacco or alcohol, the traditional ones that we all know. But as you would expect, we engage proactively with our clients on a 2-year cycle because we're very keen to, be aligned with their thoughts and with how they expect us to be shaping the fund that we manage on their behalf. So it's fair to say that we have evolved what we do from an ethical principles point of view, but we have not materially changed it. And the reason we haven't materially changed it is because our clients still tell us what they would like to see in terms of the ethics of the funds that they are choosing to invest in.
Because this is your biannual survey where essentially you write out. And what I like about the way that you do it against some others is they don't feel like leading questions. You're not trying to get the answer that you want to be able to adapt the strategy or maintain the strategy the way you do. And that I have a sense that sometimes that happens, and it makes me a little bit uncomfortable that people who don't want as asset managers to be uh, hemmed in try and sort of adjust the outcome, and you absolutely don't do that. And it must be rewarding, I would imagine, in most cases, when the stuff that comes back from clients is actually reinforcing that what you are doing is what they want you to be doing.
Yes, no, absolutely. I mean, we find it really important that we continue with this process of the 2-year survey, and certainly the feedback we get is, very well received, and it really gives us some very invaluable and fascinating input for us to consider and move forward with. As you would expect, we're meeting clients on a very regular basis, and they're never shy about sharing their thoughts on the principles that we have at the moment. But the formalization process of having that survey, I think, is really very well regarded. And yes, I think you're correct, Mike, in the sense that you say we have structured questions in the survey that we do, but we also have, quite a proportion of that questionnaire whereby we have open-ended questions and allow, clients to share with us any other aspects, any other thoughts, any other views that they may have for us to consider or engage with them on in the future. So it's an important part of what we do, and I think it's very well regarded by our investors. Certainly, that's the feedback we get from them. And very often, whilst there is a kind of a question asked, very much the text, the black and white that people choose to leave us in the open-ended part of what we offer is, incredibly interesting and helpful for us to, think about for our future ethical principles. So no, really helpful.
I think as well, in a funny way, it adds legitimacy because it's not you disconnected from the investors, but also when you're then subsequently engaging with in an investee company, and they can actually see that the you as the asset owner, steward, whatever
Yeah,
you are actually reflecting the views of the people who are owning indirectly the company into which you are investing. And
yeah,
it's too easy for companies, and I think sadly it's quite common with the biggest companies that they disregard what shareholders think. But I think with the smaller ones, and certainly when asset managers form alliances, that's when you get to the point where actually people really don't want you to be engaging in an activity or continuing in a particular direction. So from your point of view, as I say, it adds that sense of justification around what it is that you're doing.
yeah, absolutely, absolutely. And I'd be the first to kind of acknowledge that one size does not fit all in the responsible investing space, and very often we cannot please everyone with the views on the survey, and we have quite a delicate balance in terms of doing what we think is appropriate and makes the fund fit for purpose going forward. But obviously, as fund manager, I'm still very keen to have an investable universe that allows me to have suitable degrees of diversification and also deliver the financial returns that our investors would like to see over the longer term.
Is it becoming easier or more difficult to manage money within a responsible framework?
I would say, well, obviously, as we mentioned at the outset, we've been in the industry for many, many years, so 35 plus years. And the investable universe has evolved, as we say. Some stocks come in, some stocks come out. So we have managed monies in this environment for many, many years. We've also allowed ourselves the opportunity in our fund to selectively invest in some stocks that are non primary listing in the UK market. We've done that over the last couple of years. And the key reason for that is it allows the opportunity for us to, access interesting stocks from both an ethical perspective and also an investment perspective that we hold in some other mandates that we cannot capture particularly well in the UK equity market. So, that's something that, allows us the opportunity to slightly widen our investment universe. And I know some other funds in the marketplace have taken up that optionality as well. So I wouldn't say it is necessarily easier, but that is helpful. And really, many of our investors are very clear about where we can and cannot invest in the marketplace based on the ethical criteria. So they have a good understanding of when they expect the fund to perform, depending on where we are in, the economic cycle. So again, at the moment, obviously not owning resources, oil and gas, aerospace, which have been sectors that have performed incredibly well, is a challenge relative to the FTSE All-Share. However, our investors know and understand why we are not exposed to that part of the marketplace. So it really, I wouldn't necessarily say it's harder than I've experienced in my tenure as fund manager.
Okay. Should we do the thorny subject of SDR?
Yes, let's do that.
Let's do that. Let's not spend too long talking about how confusing I find it that a fund that won't invest into sustainability can't have a label, into companies that are unsustainable can't have a label, but one that will invest into companies that are unsustainable can, because that would be quite contentious. But the reality is, it has been a bewildering thing that your fund that we as advisors and on the screening side have liked for a very long time isn't viewed in the same framework as others, and it's hard for clients to quite understand what that means. And if you want to politically tiptoe around that one, that would be a joy.
Yeah. Well, I would say that my colleague who heads up our responsible investing team, Miranda Beecham, she did the majority of the heavy lifting in terms of engaging on SDR on our behalf at Aegon Asset Management. But I did accompany her in a number of meetings, both within the industry and with the FCA specifically. And we were very clear at the outset about our belief that, ethical funds, it would be beneficial in our view that they were included in the scope of what they were looking at, but they came back and were very clear that they felt that ethical funds were not going to be in scope for SDR. However, we engaged at length in detail with them over, quite a protracted time frame, discussing a variety of issues, not just for our ethical funds, but labelling generally. And ultimately, we do believe that SDR is we are supportive of its aims in general. However, I would say personally, I am slightly disappointed and agree with you that ethical funds generally have been left out of scope, because I think we are incredibly clear about what we do. We are very transparent. And we absolutely do what we say on the tin. So we are unlabeled with sustainable characteristics, and I guess I, as fund manager, was very keen that if we were to land on that, which clearly we have done, that we were not at risk of losing clients or taking clients that we had in the fund on the journey with us going forward. So again, we had a number of meetings with clients, talking about where we think we will sit in the new regulation. And it's fair to say the feedback from them, they were very understanding of that, very on top of that. And really, we have not, been detrimentally impacted as far as we can see from sitting in that unlabeled classification. What we are clearly doing, because we have unlabeled with sustainable characteristics, is that we are providing clients with some additional disclosure which we think is helpful, and certainly the feedback, as early as it is that that is being well received by clients. So, there is some benefit, but, in an ideal world, it would have been nice to be more fully in scope here. And Miranda is very proactive in continuing to engage with the FCA for our business going forward. And it'll be interesting to see how things evolve from where we are today. I think I'm right in saying that they did suggest they would re-review things after, I think it was an 18-month period.
I think it's one of those. I think one of the good things that's come out of this, if there aren't a huge number, but one of them is that the sustainability characteristics is probably the biggest bucket anyway. So as a
Yes.
consequence, you haven't been left as the sort of the slightly embarrassing over there one, and everyone else is part of the group. I think as well that, I mean, I've spoken to Miranda
Yeah.
at length about the whole SDR process. I think that the one good thing that's come out, and hopefully will continue, is transparency.
Yes.
One of my biggest concerns, both as a research screening company and also as an advisor, which is that people need to know more about where their money's invested.
Yes.
And if nothing else comes out of SDR, the fact that there is a great deal more scrutiny, a great deal more transparency for investors, I think it's really important.
No, absolutely.
And I think I've said for years, it's one of those things. Asset managers need to be more proud of where they invest. They need to not be trying to hide how they're making money. They need to say, yes, we invest into this company that you may not like, but this is why. And if it's because of something that you don't agree with, then you maybe change your mind about investing there. But be a bit more, on your front foot to say, we hold this company because we think it's actually going to make a difference. And that I think that money does make a difference, and that whether that be from investment or from stewardship. And I, I always find that sometimes gets a bit lost. People look at the numbers and say, "Why aren't you holding Nvidia? Because look what's happened." And please don't ask me again about SpaceX. But you know what I mean? That thing around, there are really good stories, and you've got stories going back decades.
Yeah. And certainly, we have been working hard with, client engagement and meetings and within the industry to, I guess, try and demonstrate a little bit more of that, because there's very much an understanding of the exclusions that we have. But we've been trying to really pull out some of the themes that are essentially consequences of the exclusions that we have. So, once we put the screening work in place, and the acceptable universe for myself as fund manager absolutely allows us the opportunity to invest in companies that are doing good, doing positive things for the environment and our society. So that's very much an output, but we've been trying to give a little bit more colour and understanding and discuss those types of themes that we have with investors. So perhaps, just as an example, one of the themes that we talk about is inclusive finance. So we're very keen that, individuals and companies have access to, affordable products and services out there in the marketplace that can, meet their needs, which are delivered in a responsible and sustainable way. So we've got a number of companies that we believe are absolutely doing that. Building better is another, I would say, theme that we very much look at. So ensuring that, products that are used in construction, whether it be in residential or in commercial, are ensuring that those products are, resource and energy efficient. So those are just a couple of examples of where we are, trying to give a little bit more colour in terms of where we're investing, but the outcomes are, arguably more beneficial. So hopefully that helps in terms of getting some of the messages across.
Yeah, no, very much. I think it's that thing that, as I say, when I started, if you're not bad, you're in, has changed a lot. So,
Yes.
one last question. Because the fund's been going for 40 years, which company have you held continuously for the longest period of time? Or which company has, if you didn't do continuous, but there's a challenge for you.
Well,
There's a top of your head that I could have warned you about before we recorded this, but
yeah.
it just
Well, I
occurred
would.
to me then. I was thinking that I'm trying
Yeah.
to think of any company that was around in 1989 that would likely still be there, and there are very few, because that sort of, 89 was when people were saying, "Oh, how exciting! You can have British Telecom and the Body Shop has come along."
Yeah,
But of
yeah.
course, whatever happened to them? So it's that thing about I wonder who your longest not continuous in total years held. I wonder what that would be.
Gosh, now that is a question that's on the top of my head. I mean, we have maybe not the longest, but one company we have invested in for a number of years and has been a very successful investment is a business called Diploma. And we very much kind of researched and invested in it when it was a small company, so sub 1 billion sterling. And what they do is they provide, basically a globally diversified, high value added distributor to a variety of end markets, so controls, seals, and healthcare. Um, and we continue to own that business today. Size wise, it's in excess of probably 9 billion market cap. It's in the FTSE 100 now. And, it is a business that has performed incredibly well, both from an organic perspective, but has supplemented that with acquisitions very, very successfully. And I guess in terms of thinking what good it does, they very much, many of their critical components help elongate the product cycle by supporting repairs and maintenance. So it allows continual usage of products as opposed to, wastage, as it were. And they are, exposed to end markets such as electrification, infrastructure, and renewables. So it's a very attractive stock from our perspective, both on its ethical credentials and also what it does in terms of delivering returns for our clients from a fund performance perspective as well. I can't, hand on heart, that is not the stock that we have had for the longest time frame. We have had it for many, many years. I would probably have to come back to you with the
Okay,
stock.
it was a very
Yeah,
unfair question, but as I say, it was only because it popped into my head, and there's only so much room in there before I got to blurt the question out. So
yeah,
it was, and that's it.
yeah,
But as well, that's a great example of the sort of thing that someone investing into, someone putting their money with you wants to know this is how you are making money for them. So it's a perfect example, and
yeah, yeah. Yeah,
that's got to be enough time on a Friday afternoon.
yeah,
You
no,
need
very,
to.
yeah, very pleasingly, many of our companies have grown very nicely over the last 2 decades, and we still own them in the portfolio. I guess what we've seen in the UK market over the last 2 to 3 years is, increased levels of mergers and acquisitions, and some of our, very interesting investments and companies have, sadly, in some regard, being consolidated by either private equity or larger corporates.
Yeah.
So, a degree of sadness sometimes when that
Yes.
happens.
It is a
But
shame, isn't it? That
yeah,
it's almost it's wrong to say, but it's almost as disappointing as when the company fails, when it just sort of disappears into something else. But
yeah,
anyway,
yeah.
it's
Great. Well, thank you so much for your time. It's been incredibly nice to speak to you
it's
once again, and I look
in,
forward to that party.
indeed 2 years time, 3 years
Indeed.
time, 40 years. Can't
Yeah.
wait.
Uh,
Thank you very much. Have a lovely
Great.
weekend.
Thank you very much, Mike. Thanks. Bye bye.
Cheers. Bye bye.